When you hear that the price of oil is negative, what exactly does that mean? And how do we figure out the price of oil anyway? It's not as simple as you might think, because it has to be done via the futures market. Even if you buy exposure to oil via an exchange traded commodity like USO, that still gives you exposure to that futures market. So it's really important to understand how it's priced and why the shape of the futures curve can affect your outcome. Now, if you want to learn more about investment, what better way could there be than to join our online community via Patreon? It's just $10 a month. There'll be a link at the top of this page, and you get to join our Sunday evening call at 8 p.m, which is very friendly. And you also get to join our online chat community, which is via Slack. So now let's look at the price of oil in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. Let's start off with what looks like a simple question. What's the price of oil? This turns out to be more complicated because you have to ask what kind of oil. So for example, oil which is pumped out of the North Sea is called Brent crude. Oil which comes out of fields in West Texas is called WTI, or West Texas Intermediate crude. And these are the two most commonly used benchmarks, although there are many others, as we'll see. But oil is always priced in US dollars, and it's normally priced in dollars per barrel, which is abbreviated BBL. And 1 barrel is about 159 litres. The US Energy Information Association produces this handy guide which classifies crude oils according to two measures. On the x-axis we have the density of the oil, with light on the right-hand side and heavy on the left-hand side, and the second dimension on the y-axis is the sulfur content, with high sulfur at the top and low sulfur at the bottom. And generally, light and sweet crude oil is more expensive than heavy and sour oil. Notice that those two commonly used benchmarks, that's Brent and WTI, are both classified as light and sweet. The center of operations for US WTI is based in Cushing in Oklahoma. This is what it looks like in Google Maps, and these circular containers are the storage tanks. Whereas the center of operations for Brent is the Sullom Voe oil terminal in Shetland. To understand many of the aspects of pricing oil, first you have to understand what we mean by a futures contract. Now the goal of this contract is to standardize everything about a single transaction in oil. And by standardizing it, that means the contract becomes much more liquid or easily and quickly tradable. So if you go long a future, that's the agreement to buy oil, for example. And if you go short, it's an agreement to sell oil. But it's an agreement to do that at a fixed price. So that might be $30 per barrel. And we standardize the amount. So that could be 1,000 barrels. And we have to specify the quality. So we might want to trade WTI. And we'd also have to specify the exact sulfur content, the viscosity, and many other attributes of the oil. We'd also specify when that oil would be delivered. So the May 2020 expiry would be delivered between the 1st and the 31st of May in 2020. And because transporting a commodity costs money, we'd also have to specify where the oil would be delivered. And for WTI, that's usually Cushing in Oklahoma. The Chicago Mercantile Exchange, or CME, which is one of the exchanges where these futures are traded, has these specifications for its WTI contract. So there's that contract size, there's a minimum price change of 1 cent per barrel, and because we trade 1,000 barrels at a time, 1 tick corresponds to $10 US. The symbol for the contract is CL, and it trades 23 hours a day with a 60-minute break at 4 p.m. Central Time. The contracts expire every month, and usually they stretch out for 10 calendar years. A critical aspect of this contract is that it's physically deliverable. That means that if you're holding a long contract, in other words you've bought oil, and we reach the expiry of the contract, then you have to receive delivery of that oil. And because each futures contract comes with an expiry date, trading has to stop on a particular day, which is 3 days prior to the 25th calendar day of the month which is prior to the contract month. Now that summary was very approximate. In order to completely standardize these contracts, there's a very long document which specifies exactly what you get with a light sweet crude oil futures contract in chapter 200 of the NYMEX rulebook. So at the bottom here, they specify exactly what kind of oil is eligible for delivery. The contract months happen every month. So for example, the May 2020 contract has a first trade date and a last trade date, a date when the contract settles, but also a date when you receive a delivery notice. So if you're a seller or a buyer, that delivery notice will give details of the transaction, such as where it'll take place, and the delivery itself can take place any time during that delivery month of May. So the May 2020 crude oil futures contract has the following specific dates. The contract first started trading in November 2014, and then it traded for 6 years. And the last trading day for the contract was 21st of April 2020. And people who were long the contract, in other words, who'd bought oil, would receive notification of delivery on 23rd of April 2020. Then the actual delivery of the oil in Cushing would take place sometime in the month of May 2020. Now the price of oil would be driven by many factors. That would include the inventory levels, but also the levels of production, the results of OPEC meetings, because these countries in OPEC and OPEC Plus control the majority of the oil supply globally, but oil also gives a read about global GDP. When economic growth is strong, that tends to push up the price of oil. Weather is also an important factor. Wars in the Middle East in particular also drive the price of oil, as do financial crises and elections. What was really unusual in April 2020 was that the price of one of these futures contracts turned negative. Here's the list of those crude oil futures contracts on the 21st of April, which was the expiry day for the May contract. And you can see that the prior settlement price was minus $38. But that only applied to the May contract. The June contract was clearly positive at $20 a barrel, as were all the other contracts. If we look at that table again on the 22nd of April, you can see that the May contract has now disappeared, it's no longer priced, and that the June contract, although the price is low at about $12 a barrel, it's certainly not negative. If we look at the price of the May contract, you can see the time when it turns extremely negative, as people became increasingly desperate to sell the contract. For a brief period of time, people were willing to pay $40 in order for somebody else to take the contract off their hands. But it didn't stay at minus $40. Shortly before expiry, the contract turned positive again. The problem in Cushing was that the amount of stocks, which is the amount of stored oil, was reaching its storage capacity. That's because the demand for oil had dropped dramatically. Refineries had reduced the amount of oil which they were using, and so the oil was getting backed up. In turn, that means that if you were delivered oil, you'd probably have to pay a considerable amount in order to store it. People were very keen to get rid of that May contract, because if they stayed holding it after the 21st, they'd have to take delivery of oil, and then they'd have to pay those storage costs. This drove the front contract down into negative territory, as people were willing to pay somebody to take the contract off their hands. And it resulted in a very steep futures curve. So if we plot the May, the June, the July, the August contracts, you can see that the prices increase very steeply. And that's called contango. If the futures curve slopes the other way, that's called backwardation. One way to calculate whether we're in contango or backwardation is to take the price of the front contract, which is minus $8.76, and subtract the 13th month contract, which was worth $32.10. And that's why some people said that the market was in super contango, because that differential became extremely large and negative. And that wasn't just for WTI, it also happened for Brent contracts. One of the structural problems with the US oil industry is that it's landlocked. A lot of the oil wells are here in the middle of the country. And you can also see why Oklahoma and Cushing is very well placed at the center of many of those oil wells. In order to be exported, that oil has to be transported down to the Gulf. So how do you actually get exposure to oil if you can't buy futures contracts? Normal investors, or retail investors as we're called, have to get exposure via other means. Probably the most common way is through exchange-traded funds. Although in the case of commodities, of course, they're called exchange-traded commodities. Something which sounds similar but which is actually very different is an exchange-traded note which is linked to the price of oil. Alternatively, you can buy funds which give you exposure to equities which deal in energy. That would be oil companies or companies which provide services or equipment to oil companies. Or you could buy an index for a whole country which has a significant oil exposure. An exchange-traded fund is just a pool of assets of which you can buy a small part as an investor. It can invest in almost anything, such as stocks, bonds, or oil, but the key thing is that you receive an interest in the investment pool. You're the beneficial owner of the assets. The fund manager is just that. It's not the owner of the assets, that's you. They just control the buying and selling of the assets. And if it's a passive index, they'll simply do that in order to track the benchmark. An exchange-traded note is quite different. It's issued by a financial institution, and in fact, it's just a bond. In effect, you're just lending money to a bank. However, the principal of the bond is tied to an index via a formula. So that might be the price of oil, or it could be the value of an equity index. Now notice that it's an unsecured debt obligation, or an unsecured bond. That's because it's not tied to any assets in particular. And if the financial institution goes bankrupt, then you could stand to lose a substantial portion of your investment. And in this case, you don't have any claim to any underlying portfolio of assets. Those would belong to the financial institution. You're also taking credit risk, because if you've lent money to a bank, if that bank's creditworthiness deteriorates, then that can push down the value of the exchange-traded note. By far the largest US exchange-traded commodity fund, which is linked to the price of oil, is USO, the United States Oil Fund. And in the UK, WisdomTree dominates these energy exchange-traded commodity funds. Notice that the management fee for these funds tends to be very high. Anything more than about 0.2% I'd consider to be expensive. Now let's look at what happened to that USO fund. The fund is designed to track the daily price movements of West Texas Intermediate light sweet crude oil. If we plot the daily return of oil, that's WTI on the x-axis, versus the daily return of the USO fund, you can see that they're very strongly correlated, although sometimes we do get big deviations from that straight line. But that doesn't necessarily mean that the two track each other perfectly. If they both start off at $1 in 2008, you can see that the price of WTI, which is in green, deviates wildly from the value of the fund USO. Now, one of the reasons for that is when the futures contracts go into backwardation or contango. When they're in contango, that generates a negative return as you sell the cheap near-term contract and buy the more expensive, longer-dated contract in order to maintain your exposure to those futures. If it's in backwardation, then it generates a positive return as you roll from one contract into the next. So at best, only expect a very crude approximation to the price of oil. There'll be a high correlation on a daily basis, but the tracking error over very large periods of time can become substantial. An indirect way to get exposure to the price of oil is by buying a sector ETF which buys shares of oil and gas exploration companies. The ticker for this example is SPOG, which is managed by BlackRock under its iShares brand. So all you can expect from this is a high correlation to the price of oil. It will by no means track the price of oil. But one positive benefit is that at least you'll be able to earn the dividends paid by these companies, which you wouldn't get if you owned the oil exchange-traded commodity fund. If we look at country indices, for which there are many cheap passive trackers, I've plotted the correlation between those indices and the price of WTI between 2008 and 2020. The ones which have highest oil exposure are the ones which have the greatest number of oil companies in the index. So that would be Brazil, Russia, and the UK. And quite surprisingly, the Nasdaq 100, which is thought of as a tech index, also has a fairly high correlation to the price of WTI. The countries which have the least exposure are China, Japan, and India. Now, some of those exchange-traded commodities ran into some problems during this very odd period for the price of oil. The exchange-traded note issued by Barclays, which goes under the ticker OIL, was redeemed. and the USO fund also ran into some problems. On April the 21st, Barclays announced that it would exercise its issuer call option. A callable bond is simply a bond where the issuer can repay its investors the current value of the bond and effectively take it out of circulation. There was so much interest in speculating on USO, presumably because many people thought the price of oil could only increase, that it ran out of shares. Because it's an open-ended fund, it could carry on creating new shares up to a limit which it agreed with the SEC, the Securities and Exchange Commission. That limit was 4.1 billion shares. At that point, it had to hold creations, in other words, stop people buying the fund, in order to file to create more shares. On April the 17th, USO had to tell its investors, via an 8K SEC filing, that it was going to change the way it got exposure to oil. It used to do this via an 80% position in the front month futures contract, so that would have been the May contract, which unfortunately turned negative, and 20% in the second month futures contract, which would have been the June contract. To avoid these kind of situations when the price turns negative, it had a proviso saying that it could instead use the second and third month contracts if the front month was within 2 weeks of expiration. Then on April the 21st, because of the super contango, they changed the rules to be 40% in June, 55% in July, and 5% in August. In other words, moving further out on the futures curve. As of April the 22nd, they became even more flexible, saying that they could invest in any month available, or in varying percentages, or a whole variety of other contracts, which includes some over-the-counter derivatives which come with counterparty risk. Looking at this optimistically, it might mean that they can more accurately track the oil price. Pessimistically, this is starting to look like a very actively managed fund, with the possibility of having some very large tracking errors if some of these contracts don't behave as expected. Now, part of this problem was that there was a technicality about storage and about the expiry of that May contract, but I think there's a broader message which the current price of oil is giving us. If we look at the credit spread of oil companies in the United States, which is a market-based measure of their risk of default, it spiked to extremely high levels recently, with yields surpassing 20%. That's pricing in a very high probability of default. So what's clear is that that sector's in a huge amount of trouble. As we saw from that map, a very large part of the United States depends on oil for its livelihood, so this could have serious repercussions for the US economy. In a Dallas Fed survey, oil companies were asked, if the price of oil were to fall to $40 per barrel, how long would you expect your firm to remain solvent? About 15% of the companies said less than a year, and 40% of the companies would become insolvent after 2 years. When asked the price of oil needed to cover their operating expenses, all of them needed a price which was above $23, and some needed a price of $36 or more. So unless the price of oil increases significantly, and that would require a pickup in demand, which requires a pickup in economic activity, then this could spell severe problems for the US energy industry and all the huge number of services companies which depend on those oil companies. So that steeply sloping futures curve actually reduces your return over time. It's not as simple as you might expect getting exposure to oil. So if you do feel tempted to speculate in markets you're not familiar with, just be very careful that you do understand those mechanics. Now, if you do want to keep abreast of what's going on in markets, why not sign up to our free weekly market roundup? There'll be a link at the top of the page. And as always, thank you for listening.